We think Toast offers a rare combination of growth, moat, and value. It's the leading operating and payment system for restaurant businesses. It's a fast growth company gaining market share rapidly from legacy technologies. The moat strength of Toast we perceive as rising as the company becomes more embedded in its customers' workflows. Despite great fears now that AI is going to destroy a lot of SaaS-based businesses and software companies, we think that Toast is actually well insulated from that AI threat and is actually a beneficiary of AI and is quite engaged in rolling out its own AI features and products. It's a founder-led management team. Two MIT classmates founded the company 15 years ago, and they've got an amazing record of execution. Debt-free balance sheet, large net cash position, and the low stock price has enabled them to initiate their first ever stock buyback, which is pretty rare for a company that's still in rapid growth mode. We have 80% upside to our $48 fair value appraisal at today's prices. So I always like to start with just a record of our prior picks for the Wide-Moat conference, Best Ideas conferences. I think this is our 13th year in a row of doing this, which hopefully 13 is not an unlucky number for us this year. Um, we've closed out all of these positions except for OTC Capital Markets, which we still hold, and Uber, which we actually took profit on part of our position, and it also declined with the same AI scare, and we rebuilt our position to being a top five position. So Uber is still outstanding in our book. One of my observations over the years of doing this is that our worst investments, our worst picks seem to be the value picks or the mature companies, and our better picks have tended to be the growth companies. I can't figure out whether that's because I'm a worse value investor than growth investor, or whether because we've just been in a environment very unfriendly to value investing. I feel like I had more success with value investments prior to this period, 2014, but maybe we're at some kind of inflection point at this point in the market. Last year's pick, Boston Beer, we actually opted to exit the position with a moderate. We actually, I think, we're pretty lucky and got a pretty decent gain, but there were so many other stocks collapsing, growth companies collapsing, that we felt we wanted to reposition that capital elsewhere. So we were able to exit. The stock has not performed all that well relative to the market, but we happened to be lucky in the period that we timed our exit. So Toast, we'll see how that goes next year and in the years beyond. So what is Toast? It's an operating system. It's a combination of hardware, software, cloud software, increasingly AI, and a financing model where they help finance their customers. It consists of these handheld units. If you've gone to restaurants, you've probably seen the Toast branded handhelds that the wait staff might be holding, but it's also throughout the back office of the restaurant, the back end of the restaurant. There's readout screens where people enter orders, where the kitchen staff can see what orders are coming in and what how to schedule and queue them. You see handheld payment processing devices where customers can pay with their phone or Apple Pay. But all of this creates and accumulates a large amount of data, which then feeds into the entire restaurant's operation. And the restaurant can add on more and more modules to their Toast subscription, which allows them to schedule employees. It feeds into financial reporting. It allows them to do all of their inventory and order management, which is a complex operation in a restaurant. And the AI tools are increasingly allowing them to design and recommend different promotions based upon what competitors are doing in the local market, where maybe a new salmon product, where should it be priced? What kind of promotion could you run to generate customer interest? So there's all kinds of tools that have branched off of this system. What are the pricing trends of the different commodities that the restaurant has to procure, and managing all the ordering and the invoicing for that. It's one really comprehensive system. And I think it helps to look at what a restaurant operation actually is. It's a pretty complex business, a restaurant. It's got a kitchen, it's got customer interface, it's got wait staff, it's got to be financed, there's marketing. And the Toast platform over the past 15 years has developed and built out features that have touch points in all of these different business functions in a restaurant. So it's the order management, it's reservations, it's wait lists, reporting and analytics, inventory management, supplier management, mobile ordering. There's a drive-through product. It manages websites and helps generate content for website, loyalty programs that restaurants use to keep customers coming back. It's got a module for catering. And then financial services, Toast Capital is a division launched by Toast to help lend money to restaurants. And since Toast is accumulating all this data on its customers, it knows which ones are profitable, which ones are likely to be good credit risks. So Toast is actually originating credits, and they retain only a little risk. They sell off that exposure to credit investors, but have a good track record of originating high performing credits, which is another growing business line within the company. So the company came public in 2021 during the big IPO SPAC boom of that era. It was a very hot IPO. It came at a really high valuation and then subsequently crashed along with a lot of the other new IPOs and SPACs of that time. Toast was not a SPAC. It went through the standard underwriting process, but it kind of correlated to all of that. Despite languishing at prices that are 70 to 75% below its IPO price for years, the company continued to execute. It's almost tenfolded its sales from 700 million to over 7 billion now. Gross profit has grown 72% CAGR over this period, continuing to scale up the gross margins. And EBITDA went from negative year after year as the company reinvested all of its operating profit in growth, and now it's inflected positively, and free cash flow has also inflected positively in the past 18 months. And we think it's really hitting a steep part of the curve and is going to scale quite impressively over the next few years. We actually bought our first position in the company in 2023, 2022, 23, after there was a big tech crash that occurred. And we'd always admired the company, and it finally got into our price range. We then sold it after it had a run up over the course of the next year and a half or so, and thought maybe we would never be able to come back to it. I mean, one of our biggest mistakes over the years is selling compounding growth companies too early. And we always were fearing that we were doing that. And we got lucky in this case, and the stocks had a 50% decline due to these AI panic scares that have happened over the past couple of quarters. And it's given us another opportunity to re-enter, and it's now a top three position for us given this opportunity.